A, and for part B, which is that it was fairly straightforward, nothing new than we've been doing over the couple of weeks. So yeah, so required one was based on the information above, you need to disclose the following notes, right? And to the annual financial statements of Logic Limited for 30th June 2012. Okay, so you are required to do the PPE note. The total column is not required, and you're also required to do the deferred tax note, right? But now there's also additional information on notes that your answer must comply with IFRS requirements. Accounting policies are not required, ignore comparative figures, right? Comparative information, meaning that you only need to do now for 30th June 2012 and not for the previous year. You need to show all calculations. That's very important, especially if your answer that you're transferring, that if it's not correct, then the mark can then go back and trace how you go to that answer, round to the nearest range. Okay, fine. And then part B as well is looking for, you need to do a note for Pop Music Limited for the 30th June 2012. So you need to do a note for the intangible assets, and then you need to do the note for the impairment, right? Fine. So all the notes that is here that deals with the narrative information, I'm not going to do it for you. I'll just point it to you that you need to take into account the narrative information that is required or that goes with that note, as far as the standard is concerned, right? Now, let me go back. So if I were you in the exam situation, so I'm gonna move away now from this, and then you need to read from your individual. So I'm gonna put now up a sort of a template that I would have used if it was me, that I would have used to answer this question or to address these requirements. So I'll put that up just now. Okay, so this is what I would have used. So the first one is asking me for PPE, right? So my note for PPE would have looked something like this. This is my template because I already know now what's happening within the question itself. So this is how my note for PPE would have looked like. And then they're also asking me for a note for deferred tax. So this is how my note for deferred tax would have looked like, right? Because I've already read the scenario, I know what's happening. Fine. But I think what's important that I've been trying to highlight as well is in terms of when you're doing your notes, you would need to indicate as to who the entity in question is and what it is that you're doing and for which financial year this is impacted, right? And then you need to say that this is in relation to property, plant, and equipment. And then the same as the other one as well, you will need to say that it also relates to deferred tax. That's very important. So because that's what you've been asked to do. So you can't just dump information and then assume that someone that's marking you will then know what that information relates to, right? So the same thing that you would have done for deferred tax, you would have to say that is deferred tax. Now remember part B or part 2 asked us to the required, we need to do an intangible note, right? And then we need to do impairment of asset. Yeah. So what I've done, I've just did everything in one sort of template in this case, but in the exam, obviously you'll do it for pop music, 30th of June 2012, and then your note needs to indicate that it's for the intangible asset. And then your note also needs to indicate that it's for the impairment loss reversal. So these, what I'm showing you now, were the required, right? So if you are responding to the required, the marker will expect to say this. So anything that goes in here will then obviously be supported by your calculations, right? So it's very important that you then reference your calculation in terms of where your calcs come from. So it's very important to say reference where you get all those amounts from. Now, anything else that I'm going to show you, meaning that now it's calculations related. It's not what was required. Your required is only the PPE note. The required is also the deferred tax note. The required is the intangible asset note. And the required is your impairment reversal note. So anything else that I'm going to show you subsequent to this, it's not part of the required. It's calculations that you're going to use to be able to answer the required. And then those calculations that's going to happen is you're going to reference them as such, right? Fine. Because I think that's very important, because what some people do is some people think, or let me say, not say some students think the fact that I've done calculations relating to building and all those kind of things, then they stop there. They think they've answered the required, but that was not what the required has asked. So if the required asks you to do, where is this now? Let me just show you quickly. If they ask you to do the deferred tax note, right? Why is it? Okay, this thing keeps on freezing now. Okay, it's not even closing. I'm not sure. So if the required ask you to do a deferred tax note, right? I'm gonna put it up just now. I'm just still open. If the required ask you to do a deferred tax note, right? So they ask you to do a deferred tax note, and you don't do that. You only do a deferred tax calc. You will be penalized, right? Because to me, I would have said that you did not address the required. This is the required. But in order to get to the required, you would obviously have to do your calculations in that regard. So I would say it is either they penalize you, or I think to some extent there is no marks. I'm not clear of that, but you would not have answered the required. So make sure that you address the required, which is the deferred tax note and not the deferred tax calculation. When they ask you for the calculation, they will specifically mention that they are asking for a calculation. Fine. Now let's start answering the question. So you're going to read in your individual questions as I am busy addressing the required in the template. Fine. Now let's go to part A. Just want to get my question quickly. Part A. Okay. So part A, you have. Okay. So part A, you have your manufacturing property, and then you've got your administrative property, right? Now, in terms of the required said they're looking for a PPE note. That is in terms of IAS 16 and not IAS 14 in terms of the investment property. So manufacturing property is in terms of IAS 16, and then the administrative property is dealt with in terms of IAS 40, which is the investment property standard. So as part of your required, I am not expecting okay, as someone is saying that the screen is, they can't see. Okay, I'm gonna fix it just now quickly. Because on my side, okay, I'm just gonna unshare quickly and then see if it's going to work, because someone's saying they can't see. Okay, someone is saying they can see on their side. So okay, I'm just gonna share again quickly to see. Can you guys see now? Can you now see the screen on your side? Because I've shared a screen. Okay, great stuff. Fine. There you go. Fine. Okay, so I was still saying that. So in your solution or in your response, I don't expect to see any item that relates to investment property in the note because the requirement is very specific. Go to the requirement again, you'll see the requirement says that you need to do a PPE note. Where is it? Yeah, it's number one says is the property, plant, and equipment note, and it says it mentions nothing about investment property. So you need to be very careful when you're reading the required, right? So Logic Limited purchased a manufacturing building on the 1st of October 2010 for 5.4 million. So that amount is broken down in terms of land was 1.5, building was 3.9, right? Fine. So where the design and printing of logos takes place, fine. The building has a useful life of 30 years and a residual value of 115,000. The building was available for use as intended by management on acquisition date. So already by now we know what that statement means. The last one that says the building was available for use. I've gone that through numerous times. Now the idea is whenever you read your scenario, you plot all your requirements so you know exactly where what belongs to, right? Fine. So in this case, you either have an option of, I would suggest that you perhaps start with your, it's entirely up to you. It's entirely up to you. But if it was me, I would have perhaps start both with with land and then address the buildings, right? So as I'm addressing land, I am also trying to do my deferred tax calc on the side, right? And then as I'm doing my deferred tax calc, I am then transferring amounts into this to this part. Fine. Now, just take note of my deferred tax calc. My deferred tax calc, it's frozen again, I'm going to open up now. Deferred tax calc, because I'm trying to show you a complete picture, right? So what I will do is I will then also try and do what would be the movement in your deferred tax in the current year, that if you were asked to perhaps record or recognize in your statement of profit or loss or in your OCI. So it's either it's P&L or it's either it's OCI, right? But so that's what I would do. But the requirement is that you only need to do 20. So in this case, the requirement only do 2012, right? But now I'm going to show you the complete picture, okay? Now, so we know that building on the 1st of October 2010, there were 5. So this manufacturing building was 5.4, and then land was 1.5, right? Fine. So my deferred tax, I'm saying I've got land at cost, right? And then land at cost in June 2011 would have been 1.5 million. What am I doing now? Right? These things, I'm not sure why Teams is doing this, but it keeps on freezing all the time. So let's just be patient quickly. Unfortunately, the Teams does this to everyone, I've noticed, okay? So your cost would have been 1.5 for property, 0.5 property, right? And then the tax base, you wouldn't have a tax base for this, right? And then this temporary difference will be exempt in this case, right? Because the idea, so remember we said initially when the beginning the rules is that from zero to cost, there is nothing that will be, there's nothing that is payable as far as in terms of this transaction is concerned. So because remember this value will then be recovered through sale, right? And then the second part is, so you have an option of transferring that amount right directly into your intangible property in your PPE note, because you already have what the cost is or what the carrying amount was on 20 June 2011, right? The next one that you're going to move on now is to the property, right? So because what we're trying to do as you read along, you then move with the scenario. You don't jump around and then go to 2012 and all those kind of things. You just move with the scenario. Fine. Now, so even the option is up to you as well, because you could have also then go and say that's land at cost, land at revalued amount, right? So the land was now revalued to 1.7 million, right? So that's what land. So land was revalued, was firstly at cost at 1.5, and then thereafter was then revalued to 1.7, right? But then remember we said from 0 to cost, we do not recognize any temporal differences implication or deferred tax implication. But anything that's above cost, we then recognize deferred tax implication, right? Because the assumption is that anything that's above cost will then pay tax in future when you sell that specific item of PPE, right? Fine. Now then, remember, in the manner of recovery in this regard is going to be through sale. Therefore, then the deferred tax that we recognize, we need then to reflect the manner of recovery of the cost, right? In this case, it's going to be through sale, meaning that it's going to be at 80% CGT. But then remember, it's only the difference between what is above the cost. So what is above the cost is only 200,000, right? And then our future tax on 200,000 is going to give you how much? It will give you, I'm just going to open up quickly. Sorry guys about this, but I can't. It keeps on freezing. Fine. So I said, so the above cost is going to give you 200,000, but then remember, because the manner of recovery for this transaction is going to be through sale, so we need them to reflect deferred tax as such, and then reflect it at 80%. Okay, 80%. Just let's see quickly. It's frozen now. Okay. So yeah. So what's happening here now? Okay. Just want to see. Okay. So if it's doing this again, I think I'll just put up the draft solution that I did, and then I'll take you through that, because otherwise it will keep on doing. It will keep on doing this. Okay, so we said at 80%. I'll try to put up the screen again now, so hopefully you can see. So therefore, your deferred tax in this regard is going to be 44,800, and then this is a liability. Okay. Fine. Now, so now what we're going to do, we're going to go to because what we're trying to do, we're trying to accumulate mass here. So remember then we said it was at cost at 1.5 and then it moved to 200,000, right? It means that there was a revaluation somewhere, and that revaluation was 200,000, right? So it's that less that gives you 200,000. Fine. So now we know at the end of 30th June 2012, in your question says, on 30th June 2012, an independent zone appraiser determined that the fair value of the land would be 17 million, right? So date is 17 million. Fine. Now we're going to move to the next item or next transaction now. Now, the next transaction is buildings, and unfortunately with buildings, there's now some few calculations that needs to be done. The first one being your depreciation, right? And then you also see that at the end of June 2012, there was also a re-estimation of our residual value, right? So we also need to take that into account. Now, now we know we bought the buildings on 1st of October 2012. 10, right? The cost was 3.9, right? The residual value when we bought the item was 450,000, right? Meaning that now my depreciable amount, which means the amount where the depreciation will be based on, is going to be 3,450 million, right? Now, with this in mind, then I'm then able to calculate as to what is going to be my annual depreciation, right? Over 30 years. So my annual depreciation is, just not remove that. So my annual depreciation is 115,000. I hope I'm right. That's my annual depreciation, 115,000. Fine. Now, in the 2011 year, so we bought this in the 2011 year, the 1st of October 2010, right? So it means that at the end of 2011, we would only have this item, this building only for 2 months, right? And then in 20, and then in, where's this now? And then in 2012, we would have this building for the full 12 months, right? Fine. Now, how many months? I'm not okay. So now we would have this for 9 months, because remember we bought it in October. So we only had it for 9 months. Now it means that we will then need to apportion that depreciation, right, for 9 months. Okay. So the depreciation for 2011 would have been 86,250, right? And then what if I were you, what I would do is I would say, so the carrying amount for 2011 was then going to be 381,370. So if I were you, I would have said the cost for building was 39, and then the accumulated depreciation to date would have been 86,250. So the carrying amount is 381,350, which agrees to 383,750. Fine. So now that's only the first part. Now we also need to go to the tax implications now, because in order for us to be able So now, so we now have a carrying amount here, 30th June 2011. It's how much? Is that amount? Fine. But now we don't have the tax base, right? So we'll need to determine as to what the tax base is. Fine. So the cost for tax will be the same, and that's nil. Therefore, the amount that you wear and tear is going to be 3.9 million, right? Now, if you go to your question, I think your question uses an annual allowance of 5% on manufacturing buildings, according to section 31, on a straight line method, and then you do not apportion for part of the year, right? That's very important. You do not apportion for part of the year, right? Meaning that now your annual wear and tear on this item would have been your annual wear and tear on this item would have been 195. Wait, let me just see what is the cost. The cost is 3.9. Yeah. So the wear and tear annually would have been 395. Therefore, your tax value would have been 307. The tax value would have been 307 something. 3705 million. Therefore, your temporary differences and then your deferred tax. This is your liability. Your carrying amount of an asset is more than the tax base, right? Therefore, it gives you a liability. So you need to know those rules, right? So now you're done with 2011. Fine. So if I were you, okay, so there is you've done 2011. Now we go now to 2012. Fine. Now in your scenario, it says that at the end of June 2012, right? What have they done? There was now a re-estimation of the residual value for the building. So now they're saying it's no longer 450, right? It's now how much? It's now 550. 1, 2, 3. That is your residual value. So how much is your depreciable amount in this regard? So what I'm asking is, what is the amount that we're going to use in order for us to be able to calculate depreciation? What is the amount that we're going to use in order for us to be able to calculate depreciation? So what is your depreciable amount? I understand we use the carrying amount, but what is your depreciable amount in this regard? Because remember, currently, so when you're looking at this year, that this building is no longer worth 3.9 million, but now it's worth 3. Where's my solution now? It's worth 3. It's no longer worth 3.9 million because we've moved past that. It's now sitting at 3,813. So what is your depreciable amount? That now, based on this change in estimate, right? So this would have then fell within the requirements of ISA 8. If you were then required to do a note, which will be then the narrative part of the note as far as the change in estimate is concerned. What is the depreciable amount? There is, I've already given the depreciable amount. Fine. Now we need to determine as to what the depreciation is. Fine. Now we know at this point we've used the building for 9 months, meaning now at the end of 2011, the remainder of the period would have been, I think, would have been 29 years and 3 months, right? Am I right? Yes, am I right? I'm right. So it would have been, so if you say 30 years times 12, that gives you 360, right? And then we've used it for 9 months. So we'll say that there's 9 months. That gives you 351, meaning that, so if you convert that to years, you would then have, I think, 29.25 years. There we go. So it's either you work with months or you work with years, whichever one is you're comfortable with in this case. So either use years or you use either use years or you either use months, whichever is convenient for you. Right? Fine. Now your depreciation for the current year, which is 2012, would have been that. You then divide by that amount. So it should give you 111,581. Yeah, so that's right. So that's the answer for depreciation in the current year. Now, do you see now your depreciation has moved from 86,250 to 111,581. So to some extent, you would have had to explain that in a narrative note or format in terms of IAS 2 as to what those changes are. That there was a re-evaluation or a re-estimation of the useful life from 450,000 to now 550,000, right? Okay, and that's about. So, fine. Now you do have what's the carrying amount. So you do have what depreciation is in the current year. You do have what the carrying amount is. So the wise thing to do to get your marks, you would then do this and say the depreciation in the current year was 111,581, right? And so there's nothing there, right? Then there's no revelation that applies to this one. Okay, that's fine. Okay, so you would have done that part. So, okay, and then also, so I think you're done with your note now. So also do not forget this part at the bottom, because you also get free marks, not free marks, but you get marks by doing this recon at the bottom. So whatever that you get in there must then be equal to what you get in there. Okay, Fine. Now, so you're done now with that part, fine. But now remember the other requirement that you also need to do is in respect of the deferred tax note, right? But we can't get to the deferred tax note as yet. We can, but I don't want us to get there now. We can, so, but I want to show you now how that it is fine. Now, remember we said we're not going to apportion for part of the year, and then we assume that depreciation remains constant throughout the years, right? Therefore, okay, so we've done 2011. So 2012, our carrying amount for buildings would have been that amount, and then our tax base would have been that amount. Okay, and that is that an asset or is that a liability? Is that an asset or is that a liability? Because remember we said if the carrying amount of an asset is more than the tax base, then what do you have? You have that is a liability. That is correct. That is correct. Okay, fine. Now that is a liability. That's correct. Fine. Okay. Be patient with me again. It's frozen again. I'm gonna open up now again. I'm gonna open just now. Fine. So now we've done the land, we've done the building, we've done the so for both years, right? Okay. Okay, the screen should be up now. Why is it? Let me just unshare quickly. I'm gonna share again just now. Okay, sorry guys about this. Just be patient with me. Even if we move over time, I'll still be with you. Don't worry about. But we will finish the question. Okay. Okay, that's fine. Now, okay. Now, what you need not confuse with what I. Why is it doing this? I'll share with you guys just now. I'm not sure what's going on. Because now it's frozen completely. It doesn't want to do anything. But anyway, we'll get there. Don't worry. Okay, there we go. We got it there. Fine. Now, what I was going to say that do not confuse my comment to say, so when I said to you, I don't want to see any investment property calculation in here, I am not saying that this is the case as well, right? Because the deferred tax is broad. We are not restricted only to PPE, right? We need deferred tax will then consider all items that are included in the scenario, right? Sorry, guys. Manufacturing, building, manufacturing, that. Okay. Okay. So what I'm trying to do now, I'm just trying to transfer whatever that we've calculated already, so that we can reflect it there, because this is how you actually accelerate it. Allowances. Yes. Okay. So just want to copy and paste this quickly over in the meantime, right? So it's going to be there. Now, so this is for manufacturing building. Okay. Now, there is still another part that you are left with, which is the administration building, right? So if you go into your question, just gonna go into the question quickly. So the question, even though that item it forms part of investment property, right? But now you're required for defect tax, it needs to include everything that is in the scenario, which is your admin property as well as your manufacturing property, right? So I don't want the comment to mislead you when I said PPE only investment property. Now we're dealing with deferred tax, meaning that when you're doing the deferred tax calc, we will need to consider the admin property, right? Because there's also tax implication in that regard, right? Fine. So the same will have land and buildings at cost, right? And then the same will have land and buildings at the revalued amount, because I already know what's happening in the scenario. So Logo Logic owns an office building that is leased to Bluebell Limited for a period of 10 years. The property was bought on the 1st of July 2011 for 2,850 million, right? So land at cost was 400,000, right? So the same principle that would have applied there, right? So from zero to cost, it's exempt, right? There's no deferred tax implication at this point, right? However, what we know is at the end of 30th June 2012, now the fair value of this property was now determined to be 3,150, and land was how much? Land was 490,000, right? Meaning that now the amount that's above, so your tax base will be 0, and then what's taxable, remember we've said anything that's above the cost. So above the cost would have been 90,000 reflected at the manner of recovery, which is through sale in this case, right? Meaning that your your temporary differences would have been 72,000 of 90,000. So 80% of 90,000, that's 72,000, and then you recognize your deferred tax. That is a liability, right? Fine. Now, we know it's investment property building. There's no depreciation that we recognize. It was investment property. So we know that we bought the building initially for, how much did you buy the building for? What is the cost that you bought the building for initially? Okay, so the building was bought for 2.45 million, right? And then what we've done later on, what happened later on, there was revaluation. So we bought for 2,503, right? And the same thing is that because, remember we said the recovery in this case will also be through sale, and then we need to reflect then the manner of the, the tax will then have to be reflected as such, which is in this case is going to be the exempt, right? Fine. Now building was then revalued from 2,450,000 to 2,650. 650. And then what is the amount that is above the cost in this case? We started with 2,450. We now ended up with 2,650. What is the amount that is above cost in this case? Things should be about 200,000, and therefore, because the cost will be recovered through the manner of recovery is going to be through sale, what we'll do then, we'll need to reflect it at the CGT rate of 80%, right? And that is a liability, fine. Now, this would then have been, so in terms of the question itself, this is the required part this year. This is the required. The top part was not the required. However, what I'm trying to do is I'm trying to show you how would a complete picture would have looked like, right? Because what I'm going to do now is I will then perhaps show you how would you have then determined what the movement is that is going to go, then what the movement would be, or what the movement is that will go into either to your P&L or your OCI? Because remember, there are items that falls within your OCI, and then the items that falls within your P&L, right? So the required only wanted you to do this section here and not this one on top. But I'm trying to show you the full picture in terms of how would you then have to determine your movement, right? Fine. Fine. So your movement in total would have been 475, right? In the beginning of the year, you started with 108,750 liability, but now you've ended with 584,169. So your movement would have been 475. So 584 less 108 is then 475, 419. That's your temporary difference movement, right? Therefore, your deferred tax would have been 133, 117, right? Then you split up in terms of what it is that I'm going to recognize in my P&L, right? So what it is that I'm going to recognize in my deferred tax expense, right? And then what it is, so what it is that I'm going to recognize in my P&L, right? Deferred tax liability, right? Just want to see, okay, it's doing the same thing again. So in my statement of profit or loss, fine. And then what it is that I am going to reflect, revaluation, right? And deferred, deferred. And obviously, you're going to put the dates if you're required to do. So this would be 31st, sorry, 30th June 2012. And then this would be your 1st of July. Fine, and then this is your OCI item, and then this would be your statement of financial position, right? So then your deferred tax that you will recognize in your profit or loss statement would have been that amount, right? And then what you would recognize in your OCI would then be this amount right here. Okay, so this is the complete picture in a case of when they ask you to do journal entries, or if they ask you now to do is it a revised profit or statement of profit or loss and other comprehensive income. So that's how your journal entries would have looked like, right? However, remember, we are not done because they've asked us to do a deferred tax note. We've already accounted for those two, but we haven't yet accounted for these two, right? So you go to, so now it's only a matter of what you're trying to do because you've already done the calc. So it's a matter of now copying and pasting now into your calculation or into your note, right? So what you do is, so it's here, the fair value adjustment. You say administrative land, and then you do the same here, fair value adjustment, administrative building. Okay, and then we simply just copy and paste what we've already done here. So that's land, and then that should be buildings. Okay, and then that's it. So this amount here must ensure that it agrees to what you've done on your calc. Because if it does not agree, then you are sitting with a problem. So it must agree. Because remember, you're taking this amount directly from here and you're inputting into your deferred tax note. Right. Now, what I think I forgot to mention to you is that with your PPE note, please do not forget the narrative information that you need to include. And then for that, you can actually go into your not study guide, you can go into your what is this? Into your TAT letter to see how that narrative information is disclosed. But those are easy marks that you can actually get. So make sure that you don't forget the part where you have to disclose or include the narrative part at the end of your PPE note. All right. Now, so we've done the deferred tax calc. So we've done the deferred tax note, we've done the PPE note. Now, what we need to do is we'll then need to go to part B. So part B dealt with your intangible asset as well as your impairment. So you need to do a note for your intangible asset, and then you need to do a note for the impairment of asset, right? Okay. While I'm still trying to load up this, if you have any questions in terms of what you've done thus far, I think you can ask while I'm busy putting this up quickly. If there are no questions, then we will go straight into the part B section. So is everyone clear for now? I think the fact that there is no comments or questions. Okay, fine. Fine. Now, so I remember I've shown you initially or in the beginning that this would be how your intangible node skeleton would look like, right? Because you already know what the scenario is about, and obviously the narrative information, but also your impairment reversal, because we know already here that we have the impairment loss reversal, right? I just want to go to the scenario quickly. Okay, so the scenario is for pop music, company that is in Johannesburg, Gauteng. They specialize in the distribution of music in South Africa. They've got a 30-year end, 30 June year end. So 1st of May, they bought the rights to the sole distributor of Rowan's music in South Africa. So this is a world famous artist from the US. So pop music bought the distribution rights to her music. So we bought distribution rights to this person's music for a period of 15 years for a total of 780,000. So this is an intangible asset, which is now named distribution rights. Right. So the residual value. So when you come at the end of the useful life of this item, we don't expect to get anything back. The rights were available for use as intended by management on the acquisition date. We know that what that means, right? Fine. Now the starting point is as an analysis, fine. So you just plot yourself. Sort of timelines or sort of a summarized version of what you're reading in there with words. You just put it in your own easily understandable way, so that you don't have to go back and forth into the scenario, right? So what you are saying, I know this was bought on the 1st of May, around 2009. It costed me 780,000. The write-off period is 15 years, or if you want to convert it into percentages, it's going to be 6.7 years. So you get that if you say 100% divide by 15. So per annum, you would write 6. Why is it? So you would write 6.67% per annum, right? So it depends whichever way you want to do it, right? Let's just close this one. So I've done this part just to show you how you would do it in years. So just gonna close it for now because we're not going to need it. Fine. Now, okay, so the requirement is that we need to do a note for 2012. Fine. Now, we need to get to a carrying amount for 2012. Fine. We know we reported this in May 29th, right? which means at 30th June 29, it would have been for, so it's May, June would have been for 2 months, right? And then for 2010 financial year, you would have used this item for the full 12 months. And then for 2011, we would have used it for the full 12 months, right? And then we stop there. Right. Now, there is no residual value here, so our depreciable amount will be the same as the cost. Now we can then determine as to what is depreciation per annum. It's going to be 780 divided by 15 years. You will get a depreciation per annum of 52,000. However, for the 2009 financial year, we only have this item for 2 months. So now we need to apportion this 52,000 only for 2 months, right? Which gives us 8667, right? For 2010, we would have had it for the full year. For 2011, we would have had it for the full year, right? Meaning that now our carrying amount, right, for the 30th of June 2011 would be 667,333. Right? Let's end there. Fine. Now let's go to the scenario. Right? Now, the scenario is saying that during the 2011 financial year, now this artist was involved in a major scandal in the US, and then this resulted in significant drop in the demand of her music in South Africa, right? Now, already we know that we're dealing with an asset that we need to impair, or we need an intangible asset that we're going to impair, right? Now, on 30th of June, the fair value less cost to sell of the distribution rights was estimated to be 550, and the value in use was determined to be 500,000. So we know that here there is an impairment that we need to do or before, right? Before we get to that, we need to do this. Now, because remember here, we're trying to earn easy maths here. Now, so we say the cost. So the cost was 780. And then the accumulated amortization, did I say depreciation amortization? Some amortization. So for now we only have what we have is the amortization, right? We still need to get to what is the impairment loss. Okay, so obviously when you're writing down, you just sum up all your, we're going to say is equal to sum. Then we're going to add the other one later on. Okay, fine. We're going to add the impairment later on. Fine. Now, it's not necessary to do the amortization calculation the way that I've done it, right? You don't have to do it one by one. You can then simply take the 18 months, right? So you say you saying that so per annum is that, right? And then now you only extrapolate it for over 26 months. You don't have to do it this way, but I was just doing this way just to show you how you actually get to those figures. So you don't have to do it this way. Otherwise, it's going to take you longer to do it this way. Right? Okay. Now, so at the end of 30th June 2011, we're sitting at a carrying amount of 667,333. Right? Now, but the question is telling us that if we should sell this item or this distribution right or whatever it is, currently the fair value of it, the less cost to sell, it's 550, which is there's already a problem because we have a carrying amount of 667, which means now something needs to happen. We need to bring it to the recent revised or the recent I don't want to say revalued, or what is currently worth in simple English, right? Fine. Now we know what is our carrying amount. Our carrying amount is 667, right? So what is our recoverable amount in this case? What is our recoverable amount in this case? They've given you what is a fair value less cost to sell. They've given you what is the value in use. What is our recoverable amount in this case? What is the recoverable amount? Should be fairly easy. What is the recoverable amount in this case? What is the recoverable amount in this case? Okay. So I don't know what the recoverable amount is, but now what I know is I have a formula that I can use in order to determine as to what is my recoverable amount. Fine. So my formula is my recoverable amount is the higher of the fair value less cost to sell. Yes, is the higher of. So you need to write it down in your script that the fair value, your recoverable amount is the higher of the fair value less cost to sell, which is 550 in this situation, or your value in use, which is 500,000. It means then that your recoverable amount, the highest is 550,000, right? Meaning that now your impairment loss is how much? Is 117,333, right? Therefore, your adjusted carrying amount is going to be 550,000. That's going to be your new carrying amount, because remember, we've written off or we've written down it to impairment, right? So it's going to be worthwhile to say, because I'm saying your accumulated amortization and impairment, so it's going to be worthwhile to then add that portion to there. Now, what this says is that at the end of 2011, the carrying amount must be reflected as 550, which is what is our adjusted carrying amount at 30th June 2011. That's our adjusted carrying amount. Right? Fine. Now, so in that, your journal entry would have looked like this. Where is it now? Just gonna open this again. Just gonna put it up quickly just now for you. Hopefully it's gonna work. Okay, so your journal entry would have been it's 30th June 2011. So we say first your amortization first, we record your amortization, and then your accumulated amortization, right? Amortization. That goes into your statement of financial position, and then that one goes into your profit or loss, right? It's gonna be 52K in the current year. What do I do now? Maybe 52K, right? But you also, what you do is you would then also record. I'm not gonna do narrations in this case. Fine. What you also do is also your impairment loss, and then your accumulated impairment loss. And that is going to be in your statement of financial position, and that's going to be in your profit or loss, right? And then this is 117,000. And then that's going to be your 117,000. So sometimes it's very nice to actually, whatever you do with the journals in case if they ask, you know. Okay, now what we're going to do is, fine. Did we disclose this? Yes, we did disclose it. Okay, there it is. Fine. Now we're going to move. So I normally say this is the current year, but don't put this in the exam. Current year. I'm just doing this for the purpose of this exercise. So this is your current year. Fine. Now, if we read further into into this scenario. It says during the financial year, Rihanna's management team initiated a worldwide image makeover project. So I'm reading now from the scenario. And they put in a lot of time and money to improve her image, right? So if the campaign was successful in SA and subsequently the demand for the music has increased. So on 30th of June 2012, the fair value less cost to sell for the distribution rights was estimated to be 650, and the value in use was now determined to be 620. Now, what I need from you is what is the amortization amount for the current year? What is the amortization amount? What is the amortization amount? What is the amortization amount for the current year? Just give me the answer. What is the amortization amount? I need you to give me what the amortization amount is. Waiting for that answer. So what is the amortization for the current year? Give me the amortization amount. Okay, how much are you getting? You're getting 62,000. Okay, I'm not sure. I don't know if that's right. Okay, fine. Now your amortization is going to be, just want to see if there's no residual value. There's no residual value. So amortization, you're going to take, you're going to take the adjusted carrying amount or the new carrying amount, which is now, it's your recoverable amount. And then you will divide by the remainder of the period or lifetime, whatever you call it. You either use the months or you use the years, whichever one is you comfortable with. Just want to see if I use that divide by that and then times by 12. So whichever one you're comfortable with. Yeah. Okay. So I have an answer of 42,857, right? I see you've got 62. I'm not sure you've got to 62, but the answer that I have is 42. No, so she's asking why do we use that adjusted carrying amount if there was no change of life or residual value, right? But then remember what we're saying is that in terms of the market conditions or in terms of the fair value that we have, this asset is no longer now at 667, right? This asset is now sitting at 550,000. That is what is worth in the market. So you cannot then use 667. You need to use your adjusted new carrying amount, right? But now after you've made that assessment to say that my carrying amount is now 550, what is then the remainder of the useful life? Because you can't assume that it's still 15 years. It's no longer 15 years. After you've made this assessment, meaning now it's your new carrying amount. So it's no longer now 15 years. You should have used it, or you have used it already for a couple of months already, right? So this new adjusted carrying amount must then be reflected with the revised or new sort of useful life or remainder of the useful life, whichever way you call it. So you can't use the 667 because we said that the recoverable amount, what it's worth, or what is worth in the market, or what you can get, if we should sell this item is now 550 and no longer 6750. And we no longer have this for 15 years now. We've already used part of the years in that regard. Okay, so you get the answer of 428570, right? Then your carrying amount at 2012 would be that less. The carrying amount would be okay. So that is your new carrying amount. Okay, fine. Now we're sitting with a problem here, not really a problem, but a problem, because what we know is that we've then assessed this item for impairment, and then we've realized that market condition has improved, or because of the campaign that was conducted, now the demand for music has now increased. Now, instead of now saying that the carrying amount is 600 and is 507, the recoverable amount currently, so you need to take on, so in testing for impairment, so our recoverable amount is going to be the higher of the 650, which is the fair value less cost to sell, or the value in use, which in this case is 620. So which one is the highest? So we've got the fair value less cost to sell, that is 650, and then we have the value in use, which is 620, right? So the highest is 655. So that's going to be our carrying amount, right? That's going to be our recoverable amount. Now our adjusted carrying amount 650, right? Now I want you to give me the journal entry, right, that you would need to do in order to reflect. Just give me a debit. So what are we going to debit? What are we going to credit? Because remember, we're doing an impairment reversal. So what are we going to debit? What are we going to credit in this regard? Just give me the account. So it say either debit depreciation or debit accumulated impairment loss or credit, whatever account. So give you what's the debit, and then you give me what's the credit. Okay, and then what's going to be the debit? The debit is going to be accumulated impairment loss, right? And then where do we recognize that? Is it in your P&L or is it in OCI? In this case, it's going to be P&L, right? So I'm doing this for a specific reason. What is the amount that you would have credited, or what is the amount that you would have debited to reverse now this impairment loss? I am asking this question for a specific reason, and I'm going to explain as to why I am asking this question. Just give me the amount. It doesn't have to be the correct answer. If it's correct, then it's 100%, it's fine. So what is the amount that you would have debited or credited to reverse your impairment loss? Okay, fine. So I see the answer is 142,857, right? And that is not correct. Fine. Now I'm going to explain to you why that is not correct. So I've done this for a specific purpose, all right? Now the requirement is, so now what we need to do, we need to do a test, right? That test that we need to do, we will then need to pretend, or we'll need to then assume that there was never impairment taken into account as part of that test, right? Because what we're trying to do, we're trying to see what will be the carrying amount if no impairment was considered or if no impairment was taken into account, right? And then we compare that carrying amount with what the recoverable amount is, right? So that carrying, then the recoverable amount cannot be more than that carrying amount. What I mean is we will then need to limit our recoverable amount or our new carrying amount. It must be limited to the carrying amount as if no impairment was recognized or calculated. I'm going to repeat. This answer of we will debit and credit with 142 is not correct, right? Because the requirement says we need to make an assessment, right? To say what would have been the carrying amount if no impairment was written off, right? So I'm saying here, assume no impairment loss recognized or written, recognized or written off, whatever way you do it, right? Because that is the requirements of the standard, right? Now, so I've done this column here for a specific purpose. Now, in this column, what we need to do is we'll assume that there was no impairment that we've recognized, right? There's no impairment that we've recognized. So now the carrying amount at 30th of June 2011 would have been the same as in this column here, right? What was the impairment? There is no impairment that we've recognized. Therefore, our carrying amount will be the same as what this is, because there's no impairment, right? No impairment in this regard. Now, our carrying amount remains that. That's our carrying amount. Fine. So now we assume that no impairment was written, right? Fine. Because what we're trying to do, we're trying to see how much do we need to adjust our, or how much do we need to write back as a reversal of the impairment. What I know is in terms of the rules is that the new carrying amount that I'm going to have must not exceed the carrying amount if no impairment was recognized. So the new carrying amount that I'm going to have, so the adjusted carrying amount that I'm going to have must not exceed that carrying amount there. Okay, let me just reshare quickly again because it's doing the same thing. I'm going to explain what I was saying again just now. Going to explain to you just now again. Fine. What I'm saying is the new or the adjusted carrying amount that I'm going to have, which is this one should not exceed the carrying amount at 30th June 2012, which is here. Where is it? Is it here? Oh, sorry, it's here. The new carrying amount, which is the 650, should not be in excess of the carrying amount that I would have had should I have not written off, or should I have not considered any impairment, right? So what is that carrying amount if there was no impairment recognized? So what is that carrying amount? Here's the answer. Give me the answer. So what is that carrying amount, right? Have no impairment been written off? So that carrying amount would be 615, right? So what this then means is that we then can't use the 650 as the new carrying amount because it wouldn't make sense to use it, because had no impairment been written off, we would have been sitting with 615, which is now, this is more than that. So our new or revised carrying amount now must be limited. This is the limitation. So that is the, okay. So this is the limitation. So that's what now we need to go and do and recognize in our books, right? Right. Now, if that is the case, then if we're saying that this is our new carrying amount, how much should we then write back as a reversal of depreciation? How much do we need to write back as a reversal for depreciation? How much do we need to write back? Right? So your write back is going to be at, so what your new carrying, your new limitation carrying amount is versus what was your old carrying amount when impairment was recognized. Then you'll get to an amount of 108,000. This is what you're going to reverse, right? Fine. Now we know that above this, there's also a difference. That difference is how much? If you say 650 minus 615, then that difference is going to be 34,667, right? But before I get to that, let's first do this. So what you do is our amortization for this year would be amortization for the year. That's amortization for the year. How much are we writing off as impairment that will be recognized in other income? In our statement of profit or loss and other comprehensive income, we are writing off how much? 108,000. That's how much we're writing off. So we know that our carrying amount at the end should not be in excess of this carrying amount where no impairment loss was recognized. Right? So those are the principles. So I'm saying to you here is, so your rules are, your new carrying amount must not exceed the carrying amount if no impairment was recognized. So that is the carrying amount if no impairment was recognized. And then in terms of the standard, and then I think you can get that from paragraph 117 up until paragraph 120 of the standard, that is IS 36. And then the excess then is going to be a revaluation. The reversal then is going to be recognized in your P&L, unless if the item is carried at revaluation, then it's going to be recognized as your it's going to be recognized in OCI, right? But I'm going to put up quickly now, it's in terms of the text that I'm referring to, right? Let me just save this quickly. And I'm just going to put up, fine. Now, a reversing of impairment loss for an individual asset, right? So the increase in carrying amount shall not exceed the carrying amount where no impairment loss has been recognized in the prior year. So that's what I've done now for you in simple rules. So this is what I'm saying here to you. So this is what I'm saying. New carrying amount will not exceed the carrying amount if no impairment was in excess, right? So that is the 615,000, right? And then what then it goes on further to say is, it says that any increase, oh, wait quickly. So it says 1118 says, so any increase in the carrying amount of an asset, right? That is above the carrying amount, which is from the 615 to 650, right? Had no impairment been recognized in prior years, will then be classified as a revaluation, right? And then any reversal of impairment loss other than goodwill, then so what we need to do, we then have to recognize this immediately in profit or loss, unless if the asset is carried on or is revalued in accordance to other standards other model, right? And then that's it. Okay. So your carrying amount in the end, what you would have to show in your solution would have, where's this thing? So your carrying amount would have been 615,333 and not 6150, because this amount here is more than what would have been there should no impairment have been recognized, or what's the proper English? If no impairment was recognized, if I should put it that way, right? So meaning that you only reverse 108,000, which is now, that will go into your other income, right? And then that's about it. So also don't forget relative information, and then your impairment loss reversal note. It's well documented in your TAT letter, and then I think you can go and look for that in your study, in your TAT letter, right? Is there any questions in this regard? Please don't forget to sign the attendance register for me. I'm trying to see if I can copy the link and then paste it for you guys. And then as well as the evaluation form that is also there. I've pasted for you just now on the link. Okay, so if there are no questions in this regard, I think I'm then going to leave you, because that's all I had for this session. I'll wait for a minute or two, and if there is no question, then yeah. Okay, so what I'll do is I'll just confirm with your lecturer quickly, because this part here might fall outside of the scope of this module, but I'm not sure, but I'll just confirm with them, let's say on Monday, in this regard. And then I'll perhaps come back to you guys, because in my understanding, this part should then be a revaluation, but if it's, I don't think it's within the scope of the module. So yeah. Okay. Okay, I think that's about it. Yeah, okay. That's about it. You're welcome. Okay. Cheers, guys. I'm gonna leave you now. Share.